Today I'll be going over Dollar General stock, ticker symbol DG. I'm going to explain why I am buying the stock along with super investors Thomas Gaynor and Seth Klarman. I'll be going over the company's business model, talk about the recent stock drop and the cause of it. I'll be going over analyst estimates over the next several years, then wrap everything up by going over my valuation of Dollar General stock and what I believe the return on investment from the stock will be at today's price. So thanks for clicking on the video today, and let's get started. Currently, Dollar General has over 19,000 stores in 47 different states. 80% of its stores service areas under a 20,000 population. The store has very small formats at about 7,500 to 8,500 square feet, but they have been playing around with possibly increasing their store square footage to about 10,000 square feet. Roughly 5% of Walmart size, but carries about 7% of Walmart SKUs. Average customer income is around $40,000 per year, with 58% earnings of under $50,000 per year. The average sales for a Dollar General store is slightly under $2 million. An average shopper visits a store 32 times a year. The average basket size is around $24, thus calculates out to about $760 a year. The competitive advantage for Dollar General is getting into areas where Walmart and other big box retail companies are not willing to go. Doesn't mean that there are no Dollar General stores near like a Target or a Walmart, but in general, they're not near those big box stores. Another competitive advantage for Dollar General is their price moat. They offer prices that are 40% below drugstores, about 10 to 20% below grocery stores, and only about 2 to 4% higher than, say, an average Walmart. Yet they're able to have operating margins of nearly 10%, which is pretty impressive. So they're able to acquire goods at a low price, offer them at low prices, but still sustain really nice margins. The management of Dollar General is very shareholder-minded. In fact, they currently pay about a 2% dividend yield, and that has gone up about 16% per year over the last 5 years. You can see this chart here going back 7 years, gone from about 88 cents per share annually all the way up to $2.62 last year, and so far this year for 2023, they paid $1.18. In addition, the company has repurchased about 35% of their outstanding shares going back to 2011. That's about a 4% buyback per year on shares, which is very impressive, which has helped increase earnings per share, thus leading to increased stock prices. Speaking of stock prices, the stock has gone down about 50% year to date, going from about $246 at the beginning of the year all the way down to roughly about $110 here today. So why has Dollar General stock dropped so much year to date? Well, there's a couple different reasons why. For one, it's deteriorating fundamentals. Keep in mind, the store was considered an essential business back in 2020 and 2021, so these stores remained open and also drove up sales and profits during that time. So going into 2022, they had really difficult comps to go against for the previous 2 years. In addition, interest rates have been elevated over the past year, putting pressure on consumers, and they have less discretionary spending. To make matters worse, theft has gone up dramatically over the past year. In fact, Target came out here recently and announced that they have seen a 160% increase in theft at their stores. Target itself has shut down 9 different stores across the nation. Walmart has also shut down stores because of theft. So a lot of retailers, including Dollar General, are seeing an uptick in theft, which is hurting shrinkage and hurting their bottom line. The second reason why the stock has dropped is because a lot of people are believing this is no longer a growth story. This is a company, we're going to get into financials here in a second, but this is a company that has grown double digits on the top line and on the bottom line for over the past decade. And unfortunately, because of these tough comps and because of the higher interest rates, we've seen a fall in sales. A lot of investors in the market is believing that this growth story from Dollar General is going to be slower going out into the future as well. However, I do want to mention that the previous CEO of Dollar General said that they were going to add about 25,000 stores. This was back in 2014. So far, they've added roughly about 20,000, which gives them still another 25% growth going out the next several years. So I don't think that their growth story has ended right now. Next, let's switch gears and talk financials. This is a 10-year financial history of Dollar General. You can see back in 2014, they had enterprise value about $18 billion. Today, it's trading at $25 billion. But you'll also notice that last year, they got up to almost $51 billion enterprise value, so it's dropped almost in half since last year. So that means the stock has also dropped by half during that same time frame. However, sales per share has gone up very nicely, going from $55 back in 2014 to $176 the last 12 months. That is a 12% compounded annual growth rate over the last 10 years and 8% over the last 3 years. So still pretty good growth overall. Now, earnings per share has gone up from $3 in 2014 to $9 here today as a 12% CAGR, matching sales. However, the last 3 years, earnings has dropped 4%. Free cash flow per share, that has certainly been hit over the last 2 years, actually dipping from $2.15 down to 43 cents here today. One reason that it's dropped is that cash from operations has certainly dropped a little bit because net income has dropped. However, they've also put a lot of money back into capital expenditures, and without having the higher sales number to support that, they've seen their free cash flow dip. Now, book value per share has gone from $17 in 2014 to $28 here today. That is a 5% CAGR over the last 10 years, about 1% over the last 3. Return on invested capital has been very impressive, averaging about 13% over the last 10 years and about 10% over the last 3 years. Now, if we turn our attention to the balance sheet, and specifically we're looking at long-term debt, debt in general, equity, and then also current assets and current liabilities. So this first section here is how long does it take them to pay off their long-term debt with their free cash flow. Typically, it's actually been, before this recent dip, on average, it's been about 2.5 years to pay off their debt. I want to see under 3 years, so that's pretty good. However, since their free cash flow has dipped over the last 2 years due to some of the deteriorating things we were talking about earlier in this video, it's jumped up to 78 years. Obviously, that looks really scary, but I think they're just going through some short-term pain right now. Now, debt to equity, I do think this is a bit concerning, going from 52% in 2014 to 286% here today because of their expansive growth. They're putting money back into the company, trying to grow their store growth. They've also brought on debt as well. I don't like seeing debt this high. I like to see it under 100%, so that is a bit concerning. However, their current ratio is at 1.4 right now, which tells me they have more current assets than current liabilities on their balance sheet, so that is looking pretty good right now. Now, as far as a market multiple that the market has been willing to pay for this company, on average over the last 10 years, it's been a 13. Currently, it's at an 8 right now. At the highest time, it was at 17. Retail stores in general, it seems like the market does not like to pay a high multiple for those. So even like at a 15 to a 17, that is pretty high for a retail store in general. Now, their gross margins have been very consistent, averaging 31% over the last 10 years, and their operating margins as well have been very consistent, being around 9% per year. Next up, let's take a look at what analysts think the company is going to do over the next several years. So they think sales is going to grow from roughly $37 billion last year up to about $51 billion in 2028. They think operating income is going to grow around 3%, net income is going to grow around 2%, free cash flow is going to grow 39%. But keep in mind, free cash flow took a huge drop. We saw that in those last table we took a look at, dropping down to around $250 million. The previous year, they were at $1.8 billion. So that is a big drop. That's why they think it's going to increase all the way up to roughly $1.5 billion in 2028. Cash from operations is supposed to grow around 17% per year. And then earnings per share is supposed to grow around 4% per year. So analysts really think this company's growth is going to slow down substantially going into the future. Like in the last slide, you saw sales growth was around 12% per year. They think it's going to be half of that going over the next several years. I do believe that the growth is going to be slowing down, but I don't think it's going to be slowing down as much what analysts think it's going to do. I actually think it's going to be kind of in the middle between what analysts think and what the company has done historically. So given that information, let's go take a look at our first valuation template right now. The first valuation template I'm taking a look at is my margin of safety calculator. I think a normalized EPS for this company is around $11. I think the growth rate over the next several years is going to be around 8% for earnings per share. Based on that information, I get a target buy price of $86 here today based on these assumptions. Next valuation model we're going to be taking a look at is my discounted operating earnings model. From here, I am trying to calculate what sales of the company is, also try to figure out what operating margins are. From there, I can determine operating income, forecast it out over the next several years, discount it back to today to get to an intrinsic value. So I think sales is going to grow around 7% per year. Again, analysts thought it was going to drop around 4%. Historically, they've been around 12%. Again, I think I'm kind of in the middle there. So 7% per year. I think operating margins are going to stabilize around 9%. So last year they were around 8.5%. I think this year it's going to dip along with next year. I think in 2025 it's going to go up to 7%, 2026 8%, and then stabilize, with their historical norms being around 9% in 2027. So based on a multiple of 15, which has been pretty close to average what the market has been willing to pay for this company, I come with an intrinsic value of $162 for Dollar General. So based on my sales growth, also my earnings per share growth, I believe that free cash flow normalized for Dollar General is roughly about $1.8 billion. So this valuation is called the 10 cap valuation. Essentially, I don't want to pay more than 10 times the operating earnings of a business. So based on $1.8 billion of normalized free cash flow for business, believing the tax provision on average or normalized is around $700 million a year, I come up to a 10 cap valuation of $114 based on this information. Next valuation template we're going to be taking a look at here is the payback time method. As an investor, I want to try to get my money back in 8 years or less. Historically, the market has been willing to pay a 16 multiple across all companies, across all industries over the last several decades. So if I can get my money back in 8 years, that's twice as fast as what the market typically is willing to get their money back on. I think I'm probably buying at a margin of safety if it's 8 years or less. Again, I think free cash flow for this business is around $1.8 billion normalized. I think the free cash flow growth is going to be around 7% per year. Based on that, I get a payback time value of 9 years. So that is more than 8 years, which based on this information and assumption says it is not a buy at this time. So here's a summary of all those valuations I just went over. So my operating earnings model says the fair value of the stock is $162. Right now the stock is trading around $110. A 30% margin of safety would be $113. So that tells me it is a buy at these levels. Now the payback time suggests a buy price of $90. My 10 cap valuation suggests a buy price of $114. Margin of safety calculator suggests it's a buy at $86. So 2 out of the 4 valuations suggest it is a buy at this time. Next up, let's talk about return on investment that I would expect to get from this stock at different stock prices. So if you're watching this video in the future and you see the stock price is at $88, I would expect basically a 25% return on investment on the stock price over the next several years. Currently, the stock is trading about $110, which is close to this 20% return on investment. So that's what I would expect to get from the stock at today's price based on these assumptions, which I will go over one more time. So I think the sales growth is going to be around 7% per year. I think operating income is going to be around 7% per year. I think the market multiple is around 15 if these assumptions are true and accurate. Again, I think the return on investment for this stock would be around 20%. Currently, the stock is also providing a dividend yield about 2%, which is really good, which is about $3.54 per share annualized. So those are my thoughts on Dollar General. I'm personally buying this stock right now. I think it's a great company at a really good price at this time. So I will continue to dollar average myself down as the stock goes down as well. The company recently announced that they're bringing their old CEO back, which will hopefully bring stability to this company and also the stock price. Now, I also believe the company is still dealing with a lot of short-term headwinds, whether it means it's theft, also consumers having less discretionary spending, also the higher interest rate environment that we're in right now, and trying to navigate the growth that they've been going through and what they're trying to get to going out to the future too, without taking a lot of debt on as well. So we could see a lot of fluctuations in the stock price, certainly over the next 6 to 12 months. But I do think long term, again, this is a great company at good value. But I would love to hear your guys' thoughts. Do you like Dollar General? Are you buying into the company now? Are there other stocks that you like even more than Dollar General? Throw it down in the comment section. Love to hear from you guys. Thank you so much for watching. Take care and God bless.